Hello and welcome to the lecture for Chapter 2. In this chapter, we kind of get into the differences between bookkeeping and accounting. So some of you may have wondered about that. So bookkeeping is kind of the hands-on recording of transactions in an organization, and accounting then is kind of a higher level of activity where you make adjustments to get the story that the financial statements tell to be more accurate. And that deals with accruals and deferrals, which we'll talk about in this chapter. So specifically, we'll talk about receivables. That's the money that customers owe us when we sell them product or services on credit. And then payables. That's money that we owe our suppliers when they allow us to make purchases of goods or services on account or pay them later. We'll show you some financial statements that deal with accruals. I'll talk about the steps in the accounting cycle. I'll talk about a couple of categories that are impacted by accruals and deferrals, one of which is supplies. Another related item is prepaid items. And then we'll talk about unearned revenues, which can be a little bit tricky. And then finally, I'll show you some financial statements that have both accruals and deferrals in them. So accrual accounting is the term that we use for accounting that is not cash-based. So in the first chapter, all of the transactions were cash-based. We did services for customers, they gave us cash. We incurred expenses, we paid cash, meaning we wrote checks or bank transfers, that kind of thing. So in accrual accounting, we separate the recognition of accounting events from when cash changes hands. So we recognize revenue when we provide the service or product to the customer, not when they happen to pay us. So as an example, if I do a lot of work for a customer in December, I'm going to recognize that revenue in December and recognize that the customer owes me money. I have money due to me, even though they might pay me in January. You can see that I should get credit for the work when I do it, not when they happen to pay me down the road. It also eliminates the possibility for manipulating results. Maybe I tell the customer, hold off or pay me early so I can recognize the revenue sooner. That doesn't really help anybody. And then conversely, we'll also recognize expenses when we incur them, not when we actually make the payment later. So if I hire you to be a consultant for me and I pay you this month, or rather you do the work for me this month, but I'm going to pay you next month, I recognize the expense this month when I incur the expense. So accrual accounting, recognizing transactions when they occur, not when payment is made, is required by generally accepted accounting principles. Those are the rules that govern how we do external financial reporting. So very, very small companies can use cash-based accounting, like maybe you have a small landscaping service or something like that, that can use cash-based accounting, but everybody else needs to do accrual accounting. And that's the subject of this chapter. The key thing is that we want to match expenses with the related revenues so that we tell the most correct story of what happened in the business. So here's another way of kind of looking at accruals and deferrals. And accrual and deferral probably aren't words you use all the time in everyday language, so I've given you some words that start with the same letter that can help you remember that. So accrual means that we need to add something to our accounting records, because if we don't, it wouldn't show up in the books. So in this case, the action happens first, meaning we do something for a customer or we incur an expense, and the cash happens at a later date. So if we're not writing a check for it, so it might not be in our accounting records unless we take the step of recording it in our accounting records. So we have to add it to our transaction grid. Deferral is similar to delay. We want to delay recognition of it until the action happens later. So the cash happens first and the action happens down the road. And I'll give you some examples of that when we get to that section. So the main type, there's two categories of accounts that have a lot of activity in this regard. One is accounts receivable. Accounts receivable is money that we're going to receive in the future from a customer. So we do work for the customer now, we receive the payment later. So when we provide the services, we're going to increase a new asset that we haven't seen yet, accounts receivable, and we increase retained earnings to recognize revenue. When we receive the cash later, it's one of those asset exchange transactions where cash goes up and accounts receivable goes down. When we're doing problems and exercises, look for the words on account. When you see the words on account, it means that we're going to be paid later. So if we provide services to a customer on account, we're going to be dealing with accounts receivable. Conversely, accounts payable is money that we're going to pay to our suppliers or pay to whoever we owe money to later. So in this case, we're dealing with salaries payable. So we incur salaries. People work for us, they do their job, but we're not issuing their paycheck until next month. So when we recognize the expense, we increase payable, salaries payable in this case, and we decrease retained earnings. This is a claim exchange transaction. So we recognize the expense, which pulls down retained earnings in the period in which we incur the expense. Later, when we pay it, we reduce cash and we reduce the liability. So that's recorded that way. And again, look for any language in a problem that says we purchase supplies or we purchase something on account. That means we're going to pay later, and pay is part of the word accounts payable. And again, in this example, I have salaries payable. We could also have taxes payable, other kinds of payables, but accounts payable is the most common. So here's a list of transactions that include receivables and payables, and in this case, salaries payable. So we could just walk through these briefly. So the first one, we acquire $5,000 of cash by issuing common stock. That's a very common initial transaction for companies. You see it's a new company with zeros for all the beginning balances. So cash goes up, common stock goes up. Next, we provide $84,000 of consulting services. Here are those words, on account. That means that tells me we didn't do it for cash, we're going to get paid later. So instead of increasing cash, we increase a different asset, accounts receivable. So accounts receivable goes up and our retained earnings goes up as we recognize revenue, again, when we earn it. Next, we collect $60,000 cash from the customers in partial settlement of its accounts receivable. So there's that asset exchange transaction where cash goes up, receivable goes down. You can see that $24,000 is still owed to us. Next, we pay $10,000 cash for salary expense. So that was an expense incurred in the same month. So cash goes down, retained earnings goes down as we recognize that expense. And then we paid $2,000 cash for advertising costs. That's a similar transaction. Cash goes down, retained earnings goes down as we recognize that expense. And then it says we recognize $6,000 of accrued salary expense. That means people have worked for us, we've incurred salaries, but we haven't written paychecks yet. Cash isn't leaving the business at this point. That'll be next month. So I increase my liability, salaries payable, and I decrease my retained earnings to recognize that salary expense that I'm going to pay next month. Then we sign contracts for $42,000 for services to be performed next year. Again, that's not a transaction. Nothing has changed in the company at that point. So it's NA across the board. And then we total things across the bottom there. So now we can produce financial statements from this information. So the first financial statement we produce, as always, is the income statement, and make note of the header there. It talks about this is for the year ended December 31st, so it's for 12 months. It's a little bit more complicated than the last one I showed you. Now we've got one type of revenue, again, when we earned it, not when we got paid. It's $84,000, not 60. And we show those expenses. In this case, $16,000 of total salaries, the 10 we paid and the 6 that we need to pay next month that we incurred this month. And then our advertising expense. So we have a net income of $66,000. When we look at the statement of changes in stockholders' equity, again, note the period of time on the header there. You can see it's in two sections there. And the net income under retained earnings, that came from the income statement. Again, that's why we had to do the income statement first. And then we've got our balance sheet. You'll note that the balance sheet is the totals of the different columns on our transaction grid, and you can see it. Balance is there, total assets are $77,000, and total liabilities and stockholders equity is also $77,000. Note that in this format, which we'll see quite frequently, there are subtotals on the far right column, subtotals and totals, and the detail supporting those subtotals is to the left. Also note on this header that's as of a particular date, not for a period of time. So the accounting cycle during the year will record transactions, we'll record adjustments like we've just seen, we'll prepare financial statements, and at the end of the year we'll close out all of the temporary accounts. So we'll talk about that later in the semester, the mechanics of doing that, but the temporary accounts are all of our income statement accounts and the dividend account. So by closing them, we effectively zero them out so that we could start fresh next year. One type of prepaid asset is supplies. So you can imagine, let's say that we have a business where we are doing janitorial work and we buy a whole pallet of a cleaning liquid like 409 or something like that because we get a really good deal on it. So we're going to buy a whole year's worth, a whole pallet on the first day of the year. Now, I don't want to recognize that as an expense in January. It would make January look horrible and all the other months look great, right? That wouldn't make sense. By the same token, I don't want to wait to expense it until it's all gone because that would make December look horrible and all the other months look great. It would distort the picture of how we're doing. So what we want to do instead is we want to keep track of how much we use each month and record the initial purchase as an asset. I buy supplies, I put them on my balance sheet, that's something I own. I could turn around and sell it if I wanted to, okay? And then each month, as I use part of it, I want to record an adjustment where I reduce that asset because each month I'm using part of the supplies, I have less of them. So I want to reduce my asset and recognize an expense. That way I'm recognizing the expense as I'm getting the benefit of doing the cleaning services that cause me to recognize revenue. So here's an example. We purchase supplies for $5,000 in cash. So that's an asset exchange transaction. Cash goes down, supplies goes up. At month end, I count the supplies and I determine that there's 3,000 that have been consumed. So I reduce the asset and I reduce retained earnings to recognize the expense of that consumption. So the problems that you'll come across, sometimes that point number 2 there is told in 2 different ways. Sometimes they'll just straight up tell you we use 3,000 of supplies, and so you do it this way. Sometimes it'll tell you we counted the supplies at the end of the month and found there were $2,000 in supplies left. Then you have to do the math to come up with, well, how much had been used up then. So just kind of have that on your radar when you're doing problems. The next type of prepaid expense are prepaid expenses that go down over time. So examples of that would be rent, insurance, sometimes advertising. In that case, you have to pay in advance for those things. So in that case, when we pay in advance, cash goes down and we recognize an asset, prepaid insurance, prepaid rent, something like that. And then as time goes by, we'll make an adjustment each month to reduce that asset and recognize the expense. The same way with the supplies. If I pay for my annual rent in advance, maybe it's $1,000 a month and I cut a check for $12,000 on January 1st for the whole year's rent, I don't want to recognize that expense in January and then make it look like I have free rent the rest of the year. And I don't want to do it at the end of the year. I want to do it as I incur it. So here's an example. On April 1st, I pay cash of $12,000 for a 12-month insurance policy. Okay, that's any of you that have car insurance, you know, you pay for it in advance. So at the end of that, and then I could do the math there. That's $12,000 over 12 months. It's $1,000 a month. So I record that transaction, cash goes down by $12,000, and I have an asset called prepaid insurance. So at year end, I want to record the expense. So 9 months have gone by at that point, April 1 through December 31st. So I reduced my asset by 9 times 1,000 per month, or $9,000, and recognize retained earnings at the end of the year. Now, of course, I could do that entry each month as well. That would be another way of doing it. So the next category of deferrals is a little bit different. It's unearned revenue. Instead of looking at cash that we pay in advance for an expense. Here we're looking at cash we receive in advance of earning it. And again, we want to separate the link between cash and recognition. So we want to recognize the revenue later when we earn it, not when we get the cash up front. So an example might be I buy season tickets for the Seahawks and I pay, let's say $2,000 for them. I pay that in the summer, okay? So at that point, the Seahawks receive my money and they recognize that they have a liability. If they don't play games because of COVID or a strike or whatever, they owe me that money back. They earn that money by playing 10 home games, right? That's how they earn it. So when they receive my money, they're going to recognize cash and they're going to recognize a liability called unearned revenue, money they owe back to the customer until they've actually earned it. So when they perform services for me, when they play their games, each time they do that, we're going to reduce the liability and recognize revenue at that point. So the way that looks in a grid here, in this example, on November 1st, we receive an advance payment of $6,000 for consulting services. So I increase cash and I increase that liability unearned revenue. At year end, I take a look and I see that we've done $4,000 worth of the services. We still owe them $2,000. So I reduce that liability by $4,000. Now my net liability is $2,000, what I still owe them in services. And I recognize $4,000 of revenue at that point because that's when I've now earned it. So here's another series of transactions. I won't read through all of those, but you can see that there are several of them I want to call attention to. Number 2, we paid $800 to purchase supplies, so that would be increasing supplies and decreasing cash. And then look down at adjustment number 1. After determining a physical count that it had 150 of unused supplies on hand, we recognize supply expense. So that would tell me we would recognize 650 of expense, 800 that we had minus the 150 that's left. The next transaction I want to point out is number 3. On March 1st, we paid $12,000 cash to lease office space for 1 year. So we would record decrease in cash and increase in prepaid rent. And then adjustment 2, we recognize rent expense for the year. So we would decrease our prepaid rent by $9,000, or no, $10,000 in this case, and reduce retained earnings by that amount. The next one, number 4, we received $18,000 cash in advance from Westbury Company for installation services to be performed for 1 year beginning June 1st. And then in adjustment number 3, we recognize the portion of the unearned revenue that we actually earned during the period. Then the last adjustment, we recognize accrued salary expense. So people have worked for us, but we haven't issued paychecks yet. That a lot of times you issue paychecks the first of the next month. So one way to record these transactions, and we've done the transaction grid, but another format for that is what I show here, which is basically we've got that accounting equation, assets equal liabilities plus stockholders' equity, and I have different accounts here where I can record it in one place and the other place. So it's just the same kind of thing, but just in a different format that I want you to see. Notice the numbers in parentheses to the left of each of the dollar amounts. That's a way of tracking which transaction where that money is going to. So you can see cash transaction 1, it increased by $55,000. And then I can look over under common stock. I see the other part of that transaction number 1 where common stock goes up by $55,000. So that gives me the ability to trace and track it back and forth. That'll produce the following income statement, which you can see is, again, getting a little bit more complicated. The statement of changes in stockholders' equity, which now we have income and a dividend that's paid, so you can see how that's affecting retained earnings. And then we've got a balance sheet that's beginning to get more detail. So they chose to not do this one with the detail to the left. It's an alternate format. If you have any questions, please don't hesitate to reach out, and I look forward to talking to you in the lecture for Chapter 3. Thank you.